John Dorsey, Executive for Control of Rattling.
Steve Meyer, Chief Investment Officer for the Bureau of Asset Management, is an invited participant.
Kevin Liu, Mayor's Office.
Nadia Pazmina, Finance.
Arthur Regner, PBA.
Alice Erno, PBA.
Frederick Winter, PBA.
Evia Boyle, Chief Wilshire.
Rob Appling, Wilshire by invitation.
Nicole Jambrisi, Police Pension Fund, present by invitation.
Anthony Borelli, SBA.
John Wood, DEA. Sorry, buddy. John Beatty, LBA.
Bobby Hackmeister, CEA.
Andy Christopher Miller, Police Pension Fund, present by invitation.
Bob Stansky, State Pension Fund, present by invitation.
Kevin Holleran, Pension Fund, present by invitation.
Ed Bowman, the Bureau of Asset Management, here by invitation.
Robert Sang, Bureau of Asset Management, here by invitation.
Ashley from Axia, present by invitation. Mariana Gutierrez from Axia, present by invitation.
David Morris, PBA, present by invitation.
Chris McGrath, PBA, present by invitation. Okay, and I apologize, I couldn't hear the mayor's office. You have the proxy also
First
for...
Stephanie Zimmer.
Okay. Very good. John?
Okay, so with that, we have a brief public agenda, which will include a market update, a performance update, and a risk presentation. So I'm going to turn it over to Steve Meyer, the Chief Investment Officer, Deputy Controller for Asset Management.
Can I just cut you off there for 1 second? The actuary, is the actuary on?
I don't see him. I do know the law department's not participating.
Okay. All right.
So let me, well, to that point, let me just say before we start, there are several members of the Bureau of Asset Management that are zooming in for the public session. In the event that they address the board in executive session, I'll ask that they identify themselves for the record. So with that, Steve, I'm going to turn it over to you to make your presentation.
Terrific, great, John. Thank you. Good morning, trustees. It's a pleasure to be here. Maybe just, as John suggested, I'll try to be brief, but not more than 10 minutes, just on the quarterly update in terms of what we're seeing. Before we get into my slide deck, I just want to make a couple points to remind ourselves, as long-term investors, we believe the following trends will actually drive performance over the next 10 years. And these trends are the things I've talked about in the past in terms of decarbonization, or the impact of climate change on our lives and the economy, shifting demographics associated with an aging population here in Europe, in China, and Japan, and the impact on labor force dynamics, deglobalization, or focus more on onshoring or nearshoring or friendshoring to have some level of supply chain robustness, the level of sovereign debt outstanding, particularly in the U.S., and I'll talk a little bit more in particular about the level of debt, the deficits we're running, and the costs associated with those higher debt levels, and the impact ultimately on the cost of capital for both private and public companies. There's an altered geopolitical risk and condition in the market, and we're looking at the impact on global trade, defense spending here and abroad, and regional trading alliances, to name a couple. And the last theme, I'd say, is transformational technological development. Here we're talking about artificial intelligence and the impact that it will have on, again, our lives and the economy and our investments. We look at these trends for a couple things. We really want to get a sense for how they impact the building blocks of both economic performance and investment returns. And those building blocks are economic growth here and abroad, inflation, productivity, public spending, and private investment. With that, let's get into it. Kate, can you advance one slide, please? There we go. Thank you, Kate. Obviously, in terms of U.S. and global inflation, the clear trend here and abroad is for lower levels of inflation. We've seen them come down quite nicely, again, that applies to the developed world. On the next slide, you can look at inflation in the U.S. The headline CPI number in white is 3.09% still, so it's slightly above 3%. The core PCE deflator, the Fed's preferred measure, is actually, I believe this is a little stale, it's about 2.8%. So inflation's come well down from the highs of over 9% in June of 2022. Fed's still got a little bit more work to do, but we're definitely working in the right direction. This also applies to the UK and the Eurozone on the next slide, Kate. And again, this disinflationary trend is firmly in place in the developed market. You can see on the far right-hand side, the peak in the US, Europe, and the Eurozone has come down quite nicely. On the next slide, a look at U.S. employment. Strong U.S. labor market is certainly supporting what's referred to as a resilient economy. The real question is, will the Fed be able to achieve its soft economic landing without having a recession? And as we go forward in time, it does seem that it's an increasingly likely outcome. On the next slide, I'll look at where we are from an employment standpoint. Employment rate, again, just 3.7%. You can see it's been quite low for quite a long period of time, notwithstanding the spike we saw in associated with COVID in 2020, significant spike. The labor force participation rate at 62.5% is still below where it was pre-pandemic. And that may have to do with a lot of folks actually accepting early retirement and not coming back to work after the pandemic. And that has an impact on labor force availability, which may be also contributing to a lower level of unemployment. On the next slide, I'll look at economic growth and what we're seeing here and abroad. Economic growth has held up quite well. It surprised many economists, given the dramatic rise in official rates we saw in the latter part of 2022 and early part of 2023. The exception here is still Japan. Japan hasn't raised rates since 2006, and they haven't changed rates since 2016. So there's still an exception, but again, that economy has shown some life, and I'll talk a little bit more about that in a moment. On the next slide, I'll look at economic growth across U.S., Eurozone, UK, Japan, and then last but not least, China in green. You can see on the far right-hand side, we've seen a nice recovery from the downdraft we saw at the start of the pandemic, the recovery, and now some normalization. The issue around China has been more topical recently, particularly today when they came out with was referred to as an ambitious 5% target for GDP growth this year. China continues to struggle under a significant property market slump. They've had issues of deflation or of decline in price levels. They have same issues that we have in terms of demographics with an aging population and a relatively low birth rate. They've got an over-leveraged shadow banking system and declining exports associated with a little less activity with some Western economies. On the next slide, look at beneficial interest rates. At one point, the market was pricing in 7 interest rate cuts in 2024. And that was well ahead of the estimates by the Fed themselves of just 3. And the market's actually come around to thinking more along the lines of the Fed now, with resiliency in the economy and inflation still being a little bit sticky. The first rate cut was expected to occur on March 20th, and that's certainly gone by the wayside. Now the market's pricing in a higher probability of the first potential rate cut in June of this year, on June 12th. The next meeting after that would be July 31st, and just be mindful of the fact that in an election year, the Fed typically, although they say they're agnostic about this, they typically try not to cut or increase rates anywhere very close to the presidential election in November. So we'll see how that all pans out in the coming months. On the next slide, a familiar look. We've actually had rates, official interest rates, pretty much on hold since the second half of last year. The Fed hasn't changed rates since July, and similar with the Bank of England and the European Central Bank. Again, the exception here on the bottom in purple is the Bank of Japan. They have not raised rates. They still have negative interest rates of negative 10 basis points. And the market is largely expecting them at some point in time to raise rates. On the next slide, I'll look at where we are in terms of treasury yields and spreads. Credit spreads have come in as the economy is more resilient, and the likelihood of a recession that would hurt potential leveraged borrowers goes down. Credit spreads have tightened pretty much across the board. U.S. Treasury yields have been really all over the place. In 2023, the U.S. 10-year traded in a range of anywhere between 3.30% in yield as high as 5%. It opened up at 4.20% this morning, and it's come down a little bit from there. So a lot of volatility as we kind of figure out where we are in this process. On the next slide, I'll look at the yield curve, how it's looked over the course of time. We still have an inverted yield curve. That's just a fancy way of saying the short rates or T-bill rates. If you're a personal investor in those, inside of 3 months, you're still paying in the 520s. So cash is king, but it is unusual. Typically, you have a maturity premium. As you invest further out the curve, you pick up some more yield, but again, it's inverted given the expectations for rate cuts at some point, in the not too distant future. On the next slide, I'll look at where we are. Another example of that, you can see the green line, that's the U.S. Treasury 10-year yield. Right now, it's around 4.20. The white line is the 2-year yield, which is higher than the 10s, which is unusual. And you can see if you look back to the left-hand side of the chart, the green is typically over the white. That's certainly not the case right now. It's still inverted by about 35 basis points. On the next slide, high yield and investment grade credit spreads, they are below their 10-year averages, again, on confidence in the resiliency of the economy, and less concern about defaults, and candidly, potentially a little stretch for yield by retail investors as well, pushing those spreads above treasuries down. On the next slide, U.S. base rates or interest rates are significantly higher than they were pre-pandemic, and stock indices at this point are near record highs here and abroad. I'll talk about Japan in a moment, but Japan actually just surpassed its all-time high last achieved in 1989 in the last few weeks. So again, 34 years to retest the highs in Japan, given the issues they had around deflation and stagnant economic growth there. On the next slide, look at benchmark returns. The fourth quarter of 2023 was actually quite good, and you can see that towards the middle of that screen. These are public market indices, so let's pick on, say, the Russell 3000, which is a broad measure of U.S. stocks, and one that we use as a benchmark against some of our strategies. It actually produced a 12.1% return for the fourth quarter, 26% return for the full year 2023. So a nice recovery, and it's pretty much across the boards in equities and stocks and bonds. Let's skip the next slide. It's just more of the same. And the next slide is a look at sovereign credit spreads. I'm sorry, Kate. Yeah, thanks. You can see that sovereign yields actually in the 10 years. On the far right-hand side, they're up in every market with one exception, that being China, because China's struggling with deflation. But across the board, you can see, as of this snapshot, U.S. Treasury 10-year yields were 40 basis points above where they opened the year until January 1st. So a backup in yields, and some of that has to do with the resiliency of the U.S. and global economy. On the next slide, just to look at returns, and this is another way of showing on the left, you can see equity market recovery, emerging market, developed market ex-U.S. and the U.S. And then the far right-hand side, a nice recovery on bonds. And we actually have with us Robert Fang, who's head of our fixed income strategies, to go through that, as well as Noah, who's going to talk a little bit more intelligently about high yield in a few moments. On the next slide, recent news, I'm trying to wrap things up. So obviously a lot of concerns around where we are on an economic standpoint. As I mentioned, at one point early in the year, late 2023, the market was fully anticipating the Fed to cut rates 7 times. There was a headline on March 1st by Torsten Slok at Apollo, who is the first one to prognosticate the fact that there may not be any rate cuts in 2024. I don't necessarily subscribe to that, but it is just an indication how the market's kind of come full circle. The economy is quite resilient. Inflation's been a little bit stickier than the Fed would like, and I think that drove that observation on Torsten's part. Also, we had former U.S. Treasury Secretary Larry Summers come out and said there's not an insignificant probability or possibility of the next rate move being a hike, in the attached a 50% likelihood to that. We'll see if that's right. On the next slide, just a look at sovereign indebtedness as a percent of GDP or gross domestic product. It's higher across all developed markets with one exception, that being Germany. On the far left-hand side, you can see they've actually reduced their debt relative to GDP. But there is a disturbing trend, and perhaps more disturbing in the U.S. Than some of the other markets, where our level of indebtedness, our public market debt right now is about 97.1% of annual GDP. These numbers actually look at gross debt. That's problematic, and the tipping point typically is thought to be at 100% of GDP or higher. You may have some trouble rolling your debt, and I'll talk about that in a moment. So again, the deficits have been quite large. Yet last year they were between 1.6 and 1.7 trillion dollars in the States. We now have $34 trillion of public market debt outstanding. there's an enormous amount of new debt that the U.S. Treasury has to roll in 2024. The average auction size is increasing by 24% this year, and the upcoming 5-year auction in April is expected to be $70 billion, the largest ever in the history of U.S. issuance. So that's going to be a challenge. Maybe skip ahead 2 slides, Kate, if you would. Or, 3 slides, actually. No, I'm good. This is the point I wanted to make, though. There is a challenge in terms of who is the marginal buyer of U.S. debt as we continue to run deficits, and irrespective of who's elected president in November, I think there's a high likelihood you'll continue to see deficit spending. Again, $1.6, $1.7 trillion, and not an end in sight. At the same time, we have foreign buyers of buying less and less of our paper. Japan continues to be the number one owner of our debt. China has actually reduced its buying of our debt quite substantially. And most of the demand right now is coming from U.S. funds. But the issue that the Fed has, and the U.S. Treasury more importantly, is if they have an auction, as they continue to increase in size, and they have what's called a failed auction or a fat-tailed auction, where they can't distribute all their paper, that would be negative, certainly negative for the bond markets. And this leads us to think that there's going to be a higher level of base rates. So the interest rates you get in your core fixed income allocations Robert's going to talk about is more generous by several hundred basis points relative to where it was pre-pandemic. But something that certainly bears watching. More food for thought on the next slide. A look at artificial intelligence. A lot of people are saying it's a bubble. And if you look at, let's run the parallel to 2000 and 2024 on this slide. The top 10 stocks tend to dominate returns. Right now we have the Magnificent Seven that are really driving returns. There is somewhat of a halo effect of that, an AI halo on some of those companies. In those companies, I'm trying to test my memory. I wrote that anyway. Those Fab Seven or Magnificent Seven are Apple, Alphabet or Google, Meta or Facebook, Microsoft, Tesla, NVIDIA, and Amazon. All 7 of those stocks in some way or shape touch artificial intelligence. And you could say, how does Tesla touch that? Well, it's the self-driving cars. They think they'll be able to harness artificial intelligence in a way that makes that much more viable. The difference, what we're seeing today relative to what we saw in 2000, however, is those top 10 companies that are driving returns are doing so very profitably. So everyone talks about NVIDIA being a bubble. It's a company that makes microchips that specifically support artificial intelligence. I think they generated a quarterly profit last quarter of $12.8 billion. So there's a lot of there. They're just generating a lot of free cash flow. The question is, can that last, and what impact will it have on stocks overall? Next slide, maybe go ahead 2 slides, Kate. Similar theme about the Magnificent Seven. You can see that expectations for corporate earnings for the Magnificent Seven are pretty flat to up a little bit in green on the top. But for the other 493 companies that comprise the S&P 500, expectations have declined quite a bit over the course of time. Maybe picked up a little bit again with the economic resiliency more recently. And on the next slide, this is the last slide I had in terms of food for thought. Ed and I have been debating whether the private equity model is a better model. I just thought this was interesting to look back to December 1996 and see the number of U.S. public companies or stocks that were available at over 8,000. The fact that those stocks have now declined to a little less than 4,500. A lot of those companies have been taken private rather, by private equity firms. There's been more consolidation. So less public stocks. You can make a strong argument that perhaps it's a better business model in a way of aligning the interests of shareholders with investors. It's also, to be candid, less transparent and less highly regulated. So that is one of the trends that we see and something to think about. Maybe just a couple of comments on your performance in particular. Kate, maybe the next 2 slides, please. Perfect, yep. So Dan Haas and I have been working together in terms of trying to put together more informative slides. This actually looks at the police total plan in dark blue relative to some of its peers, its policy return, which would be if your portfolio was at a strategic asset allocation, remember, for private assets, it takes a period of time, usually years, to get there because of pacing and vintage year diversification. But if you were fully allocated, your return would have been, say, for 1 year, 14.8%, versus where it actually came in for 1 year, 12.1%. So just a little bit more insight into where you are relative to public market equivalent of 65-35, and the median TUX fund, which is typically has a higher allocation to private assets as well. On the next slide, just a different way of looking at your returns. So that red line is a 10-year look at if you had a 7% return compounded each year, where you'd be today. The good news is you've actually, over the course of 10 years and with compounding, you've exceeded that 7% actuarially assumed rate of return. That's the hurdle that you've asked us to adhere to, and that America has also prescribed as reasonable. Again, that actuarial return at 7%. So we're going in the right direction there as well. On the next slide, we'll look at your fund's net public market returns by strategy. And there you can look at 3 months. I mean, obviously we're longer term investors. We should be focused on 5, 7, 10, 15 years. But even in the 1 year space, you can see you've had a nice recovery and return for equities, non-U.S. equities, and emerging markets as well. Pretty much everything in the last year has done quite well. And more importantly, your 5-year returns are fairly healthy, and again, powering the yield of the portfolio. On the next slide, a look at excess returns in basis points. And here, there's a lot of red in the last quarter because public markets have done so well. Some of the strategies lagged a little bit. Let's pick on, actually on the next slide. Sorry, why don't we advance one slide for now? This is a new slide that we put together to show public market fees. And these are the fees that you actually paid out for equity and bond management in the fourth quarter of last year, totaling about $12.7 million. And if you multiply that by 4, slightly over $50 million in annual fees paid to manage your portfolio a year. And I think, certainly Robert Bang and John Mercerberg have been dogged in terms of continuing to negotiate those fees lower. And again, this has also to do with somewhat of the mix of passive versus equity, and are we getting value for money in those active strategies, which we're working together to kind of figure out what might be a better way to allocate. On the next slide, I'll look at your net private manager returns. So on a net basis for 1 year, your hedge funds delivered a 3.2%, private equity 5.7%, core and non-core real estate lagged a little bit. Again, some concerns about exposure to office, retail, and potentially hotels, although you're underweight those 3 sectors, some smart weighting on John Glutzat's part and others. Infrastructure delivering 11+%, and opportunistic fixed income, again, over 10% return in the last year. A couple more slides. On the next slide, I'll look at your excess returns in basis points. And here, let's pick on private equity, the second one down. You can see that it underperformed your public market benchmark, which is the Russell 3000, by 1,510 basis points. That's a little bit of an unfair comparison because the private equity actually is priced with a 1 or 2 quarter lag. And the fact that the Russell 3000 was up fully 26% the last year is really extraordinary. So you still had a significant positive return in your private equity, but again, relative to that public market benchmark, it underperformed. Let's see on the next slide, and then I'll turn it over to Ed to give us the quarterly update on the on risk. The next slide is another one we've put together to try to provide you with more transparency in terms of how you're positioned. So this looks at your private market allocations. And on the far left, you can see private equity. You actually have invested right now $5.389 billion. The unfunded commitments that you've already made, the deals you've already approved, but they haven't yet been called, are a little over $8.5 billion. Now, bear in mind also that's a very mature holding that you've been investing in for over 2 decades, a decade and a half. So that's a mature portfolio that will generate a lot of returns as exits pick up and there's more activity. in private equity, you'll see those returns continue to come in. So it doesn't mean that your total allocation, say, to private equity is over 13 billion. You'll have returns that will be recycled and reinvested over time. So here, I'm just trying to provide a little bit more insight into the unfunded commitments you've already made. I'd say on the opposite end of that, on the far right-hand side, you can see opportunistic fixed income. There, although it's a newer asset class, you have a higher percentage actually already in the ground at 2.2+ billion, relative to the unfunded commitments you've made at $664 million. And that's because a lot of these structures are separately managed accounts, and we actually fund those at a much faster pace to be more opportunistic and take advantage of opportunities in the market. And I know I threw a lot at you, and I apologize for that, but certainly I'm willing to take any questions, anything that I've talked about that doesn't make sense or.
Okay, hearing none, let's move on to risk.
Great, thank you.
Okay, good morning, everyone. If I were to summarize what we're trying to do, all of us, is to deliver the best risk-adjusted returns. And the returns are easy to visualize. Steve did a wonderful job showing what the performance was. I think my job is a little more difficult. Risks are more challenging. It's simply a reflection, the simple fact that so many things can go wrong. Your portfolio has $52 billion. You have about 80 public managers, close to 400 private funds. Just think about number of people touching your portfolio, making decisions, thousands and thousands of people across multiple firms. You invested globally in all asset classes. So many things can go wrong. It's very hard to distill everything into a 10-minute presentation. So for the purpose of this discussion, I'll be talking about risk interchangeably with expected returns. So here we define risks as a forecasted or expected returns. Much like Steve was talking about total returns and excess returns, both are important. We'll be talking about the total forecasted returns, which mostly comes from markets and controlled through the asset allocation. And we'll be talking about the forecasted excess returns, which come mostly from your managers, from their skills, and from the portfolio construction done by staff. So what drives your risk? Can we have a first page, please? And just to take a step back, it's probably the most important thing we're talking about is markets. It's something we don't control, we observe it, we address the market risk through asset allocation. And when you think about markets, there are really just two dimensions you need to be aware of. So one is volatility. When I say volatility, I mean simply it's how fast the prices are changing. As you know, prices go up and down. It's usually the case that high volatility is associated with declining markets. Prices drop down fast, but then they go move up. So here we see two main dimensions of your portfolio, equities and fixed income. Chart number one on the left-hand side, so you can clearly see that quarter after quarter, volatility in equity markets is normalizing. So this chart is calibrated to show roughly historically typical range of volatility. So you can see in Q4, maybe slight uptick from the third quarter, but clearly markets normalized with a like normal to low range of volatility. Chart number two looks very different, fixed income. Here we're talking still about elevated volatility. Very little change for the last year. And it's simply a reflection of the fact that these markets are very unusual. We haven't had inflation in such a long time. A lot of things going on, not very good stiff, but this is just the uncertainty of the world we're facing right now. So fixed income volatility pushes your risk higher, equity pushes slightly lower. More importantly, when you talk about the second component, we have the next page, please. And that's the stock-bond correlation. And it's just a fancy way of saying that prices of bonds and equities do not move independently. What we usually expect when stocks rally, fixed income may sell off. And of course, when stocks drop, fixed income will provide a natural hedge. That's what we call a negative stock-bond correlation. And this essentially implied in your portfolio assumption. Not just your portfolio, I would say all multi-asset portfolios, this is part of the portfolio management standard toolkit. So you can see in chart number 1 that the stock bond correlation through the last 20 years stayed almost always negative. And why is that? The simple answer is inflation. And that's what we show the chart on the right-hand side, chart number 2, and the 3 distinct inflationary regimes. First of all, before the global financial crisis, inflation ran about 3%. After the GFC, inflation came down significantly and stayed slightly below 2%. And of course, now we're in a high inflation environment. And you can see how these changes in inflation regimes, what they mean for the stock bond correlation. Clearly, the lower the inflation, the lower the correlation. And that's why we're seeing that this positive stock bond correlation, which is not helpful, will roll over. You can see the inflation is coming down. It's almost normalized if you're just talking about the PC, CPI inflation. So we expect this effect to normalize over the time. And why is it important? That's one of the main inputs into the risk levels of your portfolio and uncertainty of returns. To give you an idea, with stock bond correlation moving from -0.5 to +0.5, which is within the range of this chart, will push the risk of your portfolio by about 20%, which means we need to lower the equity exposure to have the same risk levels, which means that the returns come down. So this is one of the key parameters to keep in focus and understand. With this in mind, if you go to the next page, it's also important to have a longer-term perspective. So we keep talking about the last 20 years, but let's take a big step back. Let's look to the beginning of the 20th century, and here you see that the picture is very different. So it turns out that before year 2000, the stock bond correlation stayed mostly positive, and actually a correlation of 0.5 was not that unusual. And that's one of the reasons why we talk about this radical uncertainty. If you recall our discussion about the strategic capital allocation, capital market assumptions, one of the themes put forward by them was this radical uncertainty in the markets. The world is unpredictable. We need to stay on top of what's happening in the markets, in the portfolio, and it's something we'll monitor in the background to bring to your attention. To the extent we believe stock bond correlation turns positive, there's certain things we can do in the portfolio. So currently, the portfolio has a material allocation to private assets, and they act as a natural offset for the positive stock bond correlation. That goes through the delayed, uncorrelated returns. There's some other strategies you can bring to your attention if markets dramatically have a new regime. So what it means for your portfolio, just bring it all together. Volatilities, the correlation, managers. This is the summary of your portfolio. And the risk of your portfolio stands at 11.5%. You can see this number at the bottom right corner of the table. What I mean by 11.5 is simply that the expected returns over the next 12 months will be within this range, 11.5%. So is it bad number, good number? Do you need to worry about it? So let's just put it in the context. First of all, starting with column 1 on the table, we start with so-called market portfolio. It's a very simple blend, 65-35, public assets, 65% of MSCI equity, the broadest equity portfolio, and 35% of the Bloomberg Aggregate Index, which is a broad measure of the domestic fixed income.
Hold on a second. You guys know what the ACWI is? Folks, the Old Country World Index? So it's just everywhere, and you could do ACWI ex-US, which means everything, All Country World Index minus the United States. So it's like a global index, just so everybody understands.
It's easy to get caught up in.
Yeah.
Something we so used to.
And if, by the way, if there's other terms that you hear that are like acronyms or just, you're like, what the hell is he talking about? Just chime in, you know what I mean? When you guys say 28, I don't know. You know what I mean? So, 10 whatever, and, like,
Yeah.
Is there such a code as 1020?
I don't even know what that is. Maybe there is now, you know?
So going back to that, all countries will be index. The simple portfolio of public indices has the total risk of 11.1%, you can see in column 1, and again, it's just the forecasted expected returns for 12 months. Your policy benchmark, which is aligned with the 65-35, but has asset allocation, has a risk of 10.7%, slightly lower, and that's your asset allocation in action. And also we introduce some low volatility assets such as infrastructure, hedge funds. And finally, you can see in this context that the number 11.5 makes sense. What it means, first of all, is if your portfolio is aligned with the benchmark, that's as expected, that's a good outcome. And it also means that the returns of your portfolio, total return of your portfolio, is driven mostly by the markets. And that's where the asset allocation becomes very important, is to control market exposure through the strategic asset allocation. The second measure I want to highlight on this page, right below 11.5, is the 2% risk. That's what we call active risk, and it's simply an expected excess return of your portfolio. That's what we expect to make from your managers. And we'll see in a moment where it comes from, sneak preview, started assets mostly. And finally, just draw your attention to the charts on the right-hand side of the page. They show the historical evolutions of the risks. You can see it's consistent with the chart I showed before. It's all about market volatility. As markets come down, the risk of the portfolio come down as well. So no highlights here, it's a good thing. I'm not sure you want to see any highlights of this presentation. So let's just dive into these numbers really quickly. Starting with the total risk, which is forecast of total return. Can you next page, please? Thank you. And again, just to level set, on the left-hand side, you see your asset allocation. That's, of course, the old asset allocation. We're still in the fourth quarter. We split between 3 asset classes: alternatives, public equity, public fixed income. On the right-hand side, you see what we call risk allocation. So that shows the drivers of returns and drivers of risk. And here, clearly, public equity takes the first spot. And I think we probably don't talk enough about public markets, but it's here what drives the returns, the risks, the drawn, everything in your portfolio. Public fixed income shrinks dramatically. Sorry, Robert and also behind me. But what's important here is to have a sense what drives your portfolio, and also to highlight the importance of rebalancing. So if that were not rebalancing your portfolio religiously every week, that's how your portfolio would look like all the time, and that wouldn't be a desirable outcome. And I keep saying that the risk returns are the same thing, so it's also important to connect the forecasted risk with the realized returns. So can I have the next page, please? And it's important because it's really a check on your asset allocation. So we do strategic asset allocations once every 3 to 5 years. We'll obviously the beginning of implementation of the review is approved by the board, but it's something that we watch continuously. Just because we do it every 3 to 5 years doesn't mean that we leave it alone. And this is really the check on your asset allocation. So starting with chart number 1, which shows the highest level is the whole portfolio, the vertical bars show the forecasted or expected return. The dots or triangles show the realized return for the fourth quarter. What you can see here is your portfolio, labor police, slightly outperformed the expectation, which is not a bad outcome. And it's clearly driven by the public markets. Both public equity and public fixed income delivered the returns well in the excess of expectation. And it's really driven by somewhat unusual nature of private markets. And probably markets are always unusual, let's face it. But we're going through almost like a roller coaster. Bad markets, good markets, soft landing. Now we're talking about soft landing and takeoff. But the markets performed well in the fourth quarter. Equity markets were strong. You can see chart number 2, both U.S. equity and developed U.S. delivered very strong performance. Fixed income delivered good performance, both core fixed income and high yield, and it's driven by decline in interest rates and shrinking credit spreads. So all is good here, nothing to complain about. Moving to the second dimension of risk. To the next page, please. Active risk, which just to remind you, is a measure of the expected future excess returns over the 12 months. And here we show you the excess return, expected excess return, which just to remind you is about 2%, and also the composition of this expected excess return. So you clearly see that it's driven almost exclusively by the private assets. It's not entirely unexpected. That's exactly why we invest in private assets, to realize excess return, the excess premium for illiquidity. Private equity clearly dominates the picture, which again, nothing unexpected here. Which may be slightly less expected is a fairly low contribution of public assets. You can see that public equity contributes just 10 basis points to excess return, and public fixed income also is a fairly small contribution. I just want to highlight this one of the ongoing projects within the BAM. We're trying to understand the nature of these exposures, and it's a better way to build portfolio to make your attention. And finally, just to finish with the risks, can you go to the next page, please? Again, the same exercise, we need to compare the forecasted returns against the realized returns. And this is important, ladies. This is a high-level check on your managers. Like if anything happening, anything unusual within the managers, that's where it will show up. And here we show you just a condensed version. Internally within BAM, we'll look at all managers and we'll do more thorough analysis. So again, starting with chart number 1, which shows your entire portfolio, you can see that everything is well within the range. The forecast connects with the performance, like check, check, check. Looking chart number 3 at the bottom of the page, we'll look at the equities. And again, all 3 regional fleets, U.S. equities, developed ex-U.S., major markets, check, 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 all within expectations. Chart number 4, fixed income, I'll cover it very superficially because Robert knows it can go into more details. So you can see that high yield actually delivers the performance, negative excess return, so it was below expectations. And that's broadly speaking was the defensive positioning of the managers. Going back to what I mentioned before, is the uncertainty about the current environment. I think most of the managers expected less or about recovery of the markets. You see exactly the same in core fixed income. And the managers were more defensively positioned versus the market. And for this quarter, it didn't play out. So we talked about so far about the past. We talked about these, how we forecasted them and how connected. So we just spent a few minutes talking about the future. Of course, the important question is, the past is the past, but will your portfolio performance expected going forward? Can we have the next page, please? And we're talking about the future. There are really 2 parts to it. First of all, what is the future? Nobody knows, but they make an educated guess. Second of all, how will your portfolio respond to this possible shock? So, talking about the potential future of the markets, we split the whole universe into 3 broad buckets: equities, rates, and commodities. You don't invest in commodities, but they still drive the risk and exposure to your portfolio. And within each of these buckets, we take the 3 most important markets, like for equities, obviously, the S&P, emerging markets, and European stock market. And I'm not going to read you all these numbers. I just want to highlight 2 facts. First of all, the range of uncertainty is fairly high. If you look, for example, at the S&P, which is chart number 1 in the upper left corner, when we put together this page, the S&P was still back at 4,900. Today, it's 5,100. Things move fast. So what we asked our risk system buyer 1 from MSCI, what is the worst expected monthly outcome for the next 12 months? That's exactly what you see on this page. And our risk system forecast that, for example, the S&P may move up and down by about 22%. It's a wide range. Look at chart number 9 in the bottom right corner. That's where we talk about inflation. Talking about 2.5% uncertainty. This is very broad range. We can see a chance for inflation to accelerate, as people were just talking about various farmers, talking about potential re-acceleration of inflation. There's also a chance of inflation collapsing. I'm not making any forecast, but it's possible. So how will your portfolio perform under all these shocks? Let's go to the next page. Thank you. And that's where you see the same 9 scenarios, the same 9 factors, equity, trade, and commodities. And you see, starting with column number 1, labeled absolute return, look at risk on and risk off environment. So a few takeaways from this page here. I'm not going to read these numbers, I promise you. First of all, the way we calibrated the system, each one of these shocks equally likely. The probability of the shocks is exactly the same. So the first thing that jumps to me, the biggest risk is U.S. equities. And I'm sure I'm not breaking any new ground to you. It's a good confirmation. Probably what's more important is to compare the response to the S&P emerging market in Europe. The risks you're taking are U.S. equities still. And that's important because you may invest in the European stocks that take economical exposure to the U.S. market. You may kind of double dip without knowing it. That's not capital. So application is working. It's a good outcome. Second, you're looking at the rate bucket, the green bucket in the middle. We highlight the 2-year treasuries, 10-year treasuries, and also the euro-dollar exchange rate. And it turns out that the euro-dollar exchange rate is more important than the U.S. Treasury curve. And it's simply a reflection of the central role of U.S. dollar in the global economy. And broadly speaking, a decline in the U.S. dollar will be positive for your portfolio. And let's look at commodities. Probably the most important category is actually copper. And copper is a proxy for global economy. Copper goes into anything. It drives artificial intelligence. It drives power generation. It drives cars. Any manufacturing uses copper. And that's why copper picks up in your exposures. So looking at this, between the exposure to U.S. equities, exposure to euro-dollar exchange rate, exposure to copper, one summary I have here is your portfolio is pro-cyclical. You're positioned to benefit from the economical growth. And I would say it's not necessarily a bad position. That makes sense. The last thing I want to highlight on this page, looking at the risk on, risk off environment, market rally versus market sell-off, where you want to be is what we call convexity. Just a fancy term saying that you gain more on the upside than what you lose on the downside. You want this symmetry of returns. That's exactly what we see on this page. You see it almost every scenario, you either gain more on the upside or at least you're not losing more on the downside. And as a result of the application, you get a check on the application. So looking forward, we'd say that the 1% predictable, but I can say from this page that you positioned well, and at least wouldn't see anything in your current application and managed selection that needs to occur. I'll stop here, open for any questions.
Okay. Any questions? All right. Hearing none, I believe that concludes the public agenda. And with that, I'll make a motion that we exit public session and enter into executive session. Is there a second? Al, second?
Yeah.
Okay, so we'll ask that ma'am cease the recording. Actually, before we cease the recording, I just want to note that Stephanie Zimberg is joining us via Zoom, consistent with the policy here at PPF. So with that, I'll ask that we just cease the recording.
And John Dawson.
Can we put the cameras on? All right, Kevin, time to report out.
Okay, during the executive session, the trustees heard from their consultants, BAM, and several managers regarding public fixed income, annual excluded securities list, and alternative credit. Decisions were made. Those decisions will be made public at the appropriate time.
Okay, and with that, I'd like to make a motion to adjourn.
Second.
All right. All right, we stand adjourned. Thank you all.